All right, we are about a minute away from getting it going. Jules, hope you enjoy your dinner. Sierra, thanks for checking in the Twitch chat. If you guys are anyone else sitting there watching, waiting for the timer to get down to zero, feel free to check in and say hello before we get it going. Dashio, how's it going? Let's do it. Matthew M on the YouTube chat. Love to see it. Welcome back, guys. 10 seconds. And that is the end of the timer. So when this notification comes up, I can click it. I will X out. All right, we are back. Thank you for joining us for another edition of me sitting and talking to myself and hoping that someone is there on the other side listening. And it looks like there are at least a few people on the other side listening tonight. So it is not all for nothing. But, you know, we already had a pretty big rundown Sunday night about what we were looking at headed into the week. As you could see, I've indicated the 4 new positions that we entered into this week. 2 of them we got in and out of. CLF was one that we identified Sunday night that had some really solid premium and was part of a 10-day play. And we did have a question about, you know, what is a 10-day play? Because admittedly, that is one of the videos that I have not made yet to explain, you know, some of the strategies that we use surrounding option selling. So we'll talk a little bit about that tonight. Virgin Galactic, we got in and out of that one. That was one of those IV reversion plays that we also talked about on a Sunday night. We identified that opportunity Monday morning on the big drop at open, and I am very glad in hindsight now that we got out of these because the ticker has dropped below $35 a share, so we know that these would have been in a losing position. But that's kind of the idea with this IV reversion play, right? You get in when the IV's high. You know, if the stock doesn't just severely move against you for a sustained period of time, the IV is going to drop back down, and you'll be able to take a little bit of profit, and that's exactly what we did. And then we entered into 2 series of Clover Health puts. We have an 8-strike put expiring next week, and then a 9-strike expiring this week. Those are looking, after today, I think a little bit interesting, because Clover Health has dropped down to, we could see it right there, 868. But hey, back up to 875 after hours. But that's the great thing about when we sell these puts, right? We know that if it, you know, sticks at 875 come Friday at close, these are going to be worth 25 cents. And voila, we are looking at a gain on that position overall. And again, for these ones we have next week, you know, it just needs to stay above 8. So if we pop open the chart for CLOV, we know that as long as it stays above this line right here over the next 7 trading days, we are going to be good to go. So not terribly worried about those. And we always say rule number 1 is, you know, sell puts on stocks that you would be comfortable owning. We may have violated that a little bit here, and that's why that's in that premium chasing section. Because admittedly, some of these are a little bit riskier on stocks that aren't as strong as what we've got going on up here. So you know, that kind of comes with the territory. But as you can see, you know, a lot of these, if we highlight our premium chasing section on the week, right, we've made $733 because in the end, it's all just a numbers game, right? We're putting ourselves in positions where we think the premium outweighs the potential move in the stock, and we're going to be able to benefit from that. And while we do try to select stocks, you know, they're looking as if they're bottoming out a little bit. And that's what we were able to do with DI. I guess I'll call it DD. And some of these other plays. ASTS we got out of today for 65. I've got to update that one and then unhighlight it. But yeah, that's kind of the activity that we had this week. Prinzmeister in the Twitch chat asking about BBIG. That one, you know, I'm not terribly worried about. It sucks that it got beat down with everything else today, like you mentioned. We lost $406 on that on the week, and we were looking like we were going to coast to you know, getting these called away for 4 this 0, looking at what would have been a $644 gain. But as it stands right now, we're in a loss position of about $200, which isn't the worst thing in the world because, as we know, if BBIG finishes below 4 come Friday afternoon, These are going to expire worthless, so we're at least going to be able to squeeze another $160 out of these. So no harm, no foul there. It sucks that it's not going to be up at 4, but the great part about BBIG, if we pull this chart up right here, as you can see, we had a pretty steep drop over the past couple days, but again, that's kind of one of those things that happens, and we use these strategies that we use because it protects our downside. This is the downside situation. How are we going to bounce back from it? I think it might be helpful if I pull up the individual trade tab that we have here really quickly. So, it started at 379 when we got into this on June 30th. We saw that there was some really good premium on the July 16th 4-strike calls. And, we sold those. So we know that when we purchased the shares for 379 and sold 4-strike calls for 35 cents a piece, our break-even price is going to be 344 overall on the trade. So what that means is once these expire, they are going to expire. They're going to leave our account. We'll have uncovered shares. So while it sucks in the short term, because, let's not lose sight of the fact that we're still in a profitable position overall here, right? We have a very small amount of capital invested in this. What we have received in profit, if BBIG stays where it is equal to just under a 3% return on capital in less than a month, which annualizes to almost 93%. So, this is a very good play, right? We could just dump these shares, get out of it, and call this a winner, because anytime you could pull together something that has a 93.18% annualized return, that is a successful trade. You were going to make a lot of money week after week, month after month, and year after year if you're getting into something like that. However, once these expire and these disappear from our account, we're just going to go right into selling, 14, and these are going to be 824. And here is where it gets interesting, right? We don't necessarily have to sell 4-strike calls again. And the great part about BBIG, and one of the reasons we chose it for this strategy is, one, when you look at the option chain, there are options at every single 50-cent interval, which provides a really good amount of flexibility. One of the biggest issues that we had with our AHT play is that we had some trouble rescuing it because, the intervals of the options are only $2.50 intervals. So you kind of get into a situation where you're in no man's land when you get between the strikes here, and these are below all the strikes because this stock is kind of fallen off the face of the earth after we exited. But that does become a little bit of an issue with BBIG. You've got all these strikes at 50-cent intervals, so you have a lot of flexibility in what we're going to do going forward. So looking at these August calls, premium, unless the stock moves severely in the next couple days, is going to remain largely unchanged. So I think the way that we're going to approach this, what we want to do is get our basis. As you can see right here, our break even is 344. And that's a 9.23% reduction from the price that we got in at, right? We have a 344 basis. That's 9.23% below the initial stock price at 379. So again, that's pretty good, because as long as BBIG didn't drop 9.23% in the 2 weeks that we had this play, we're going to make money, and that's exactly what we're seeing. It's down 7.12%, but we're pulling just under 3% return on capital. So when we look at August, we want to keep this break-even price in mind. So every cent we get in premium on these calls is a direct reduction of the cost basis we have of 344. So we could sell, we can get away with selling a 5-strike call for 45 cents. That would take our break even down to about $3 a share, and we could kind of finish this out here, right? On 7/16 is when we would roll these. This is going to be this Friday. And if we wanted to do the 5-strike calls, we could sell those for, between the 5 strikes right here, between 40 and 45 cents. We'll go on the conservative side. We'll call it 42 cents. And we know that our new break-even price is going to equal our old break-even price minus the 42-cent premium that we got, meaning our new break-even price is going to be 3.02%. That is a 20.32% reduction in our break-even price from when we got in. And what we accomplish here by stepping up from the 4 to the 5 is that before, our gains on the stock were capped right here at $294 because we would have to sell the shares for $4 a piece. This now lets us potentially sell the shares for $5 a piece, which opens us up to another $1,400 in profit from the shares. So we have more upside while decreasing our downside risk. And that's one of the biggest reasons that we got in on this in the first place, because that option premium on a month-to-month basis is so nice, right? So we're going to be getting, $588 from that no matter what. with the potential to get it up to 5. And that would give you, if this thing got up to 5 by August 20th, that turns into a 72.68% return on capital, where if this play ended on 820, you now go from what was previously a 93% annualized return to just under a 5,000% annualized return. But again, that's if this thing runs up to 5, right? It could stay flat at 3.5, and you're still looking at some pretty impressive numbers. It would have to run all the way back down again to 3.02, our break-even price, for that profit to zero out and for us to start losing money. But again, that would be a 20% drop in the stock in about a month and a half, which, couldn't it happen? Absolutely, it could happen. However, it's not likely, right? We put ourselves in these positions where profit is likely, and that's why in the long run we're going to be making some money. To address a couple of comments, Prinzmeister saying, what if we sold the BBIG 4-strike put? Would it be better? And I'm assuming you're saying that meaning that, instead of buying shares, selling covered calls, you just sold the 4-strike put, and that's the position that you're carrying. Your question now is, would it be better to self-assign before the end of the week on Friday? So let me quickly back out all the changes that I made to this so it's correct. There we go. I think that's right. So if we look at the BBIG 4-strike put, right, the rule of thumb we have about, excuse me. Yeah. So you sold the 4-strike put at 40 cents yesterday. Tough break today. However, not all is lost. The rule of thumb about when we want to, manually assign ourselves shares of the stock is based around extrinsic value that's remaining. So if we go to option theoreticals and Greeks, go to extrinsic, you'll see here on 4-strike puts, there's still 9.5 cents of extrinsic value left in these. That's a pretty significant number for, a stock trading at this level. Now, if you had 9 cents of extrinsic value on a stock like Amazon, where it was like at $3,000, whatever, 9 cents of extrinsic value, who cares? However, 9 cents of extrinsic value on a stock that's trading at $3.52, if I get the calculator up right here, taking a sec, come on calculator, there we go. 9 cents of extrinsic value on a stock that's trading at $3.52 is 2.55% of the value of the stock, right? So by manually assigning yourself right now, you would forfeit all those 9 cents of extrinsic value remaining that's going to decay on those puts, and essentially forfeiting 2.5% worth of a return. So what we want to do is not tomorrow, but Friday afternoon, typically, 3:30, 3:45, when you're getting towards the end of the trading day, that's when all that extrinsic value is going to be evaporated. And that is when you're going to want to, do what we call quote unquote manual assignment, where you dump those puts, you buy the shares back to back, and then you sell covered calls. So now you get to take advantage of theta decay over the weekend, as opposed to having to wait until Monday to be assigned shares and potentially leave yourself at risk of the stock tanking over the weekend and then you not being able to sell covered calls at a favorable basis. And one other thing I wanted to address with this BBIG play is you'll notice that as far as capital invested is concerned, we kept it on the low end. And we did that because, when we run the HT wheel, we only want to invest 50-60% off the bat. Let's see. And I think this is really going to relate to that question Prinzmeister's putting in there, saying, since this is a monthly option stock, would you consider possibly selling the 3.5 put to as a hedge, or is it not worth the risk? So that's exactly what I'm going to address right here, right? So we stepped into this play with, for us, what is a smaller amount of capital, about 50% of what we would be comfortable pouring into this play, with the idea being that, hey, if BBIG tanked on us, we would take assignment of the shares. I guess we already had the shares. We would sell more calls on the shares that we had, and then we would leg into the covered strangle that we like to talk about in our HT wheel strategy. However, I don't like the idea of getting into a strangle just yet, and I'll tell you why. The strangle obviously is this not last ditch, because you could do it a little bit further as you move down the wheel diagram that we put together. But it's one of the, the biggest lines of defense as far as what's going on with this number over here, our break-even price. And we don't want to, show our hand too early as far as the strangle is concerned, if that makes sense. So the way that I view it is when do I want to open a strangle on stock that I'm either assigned or I have to keep selling covered calls on? That's the situation we have right here. And the answer is this number right here. If my position is profitable, I don't need to worry about, doubling down, throwing more capital at it to further lower the break-even price. Because, if things stay flat, which is the way that I evaluate a lot of these trades, we're going to make money. So until BBIG, once we sell these, 4 or 5 strike calls, whatever we decide to do on Friday, depending on where the stock finds itself. So, but before, lost my train of thought there. But when we decide to sell those calls, we're going to wait. And we know our new break-even price is going to be right around $3 a share. So we want to wait until that break-even price gets tested again to leg into the strangle. And you might say, okay, well, what if the break-even price doesn't get tested and it stays well above $3 a share? Well, the answer is we've made money. We've done our job. So that's exactly what we're going for with any trade that we enter. We want to make money, right? So as long as this number right here is green, and again, this calculates as if the extrinsic value is gone. This calculates what the value would be at the day of expiry. As long as this number is green, I don't really want to enter into a strangle. But the good part about this one is that if you look at the August chain for puts, there is some serious value on puts right here, right? You could sell a 3-strike put for 40 cents a premium, which is the equivalent of you getting shares at $2.60 a pop. And when we take a look at the chart here, let's back it up to, let's go 180 days. We see a little bit of a base here because I don't want to act like, the downside to this level is completely out of the question. I think we could see 3 again, but let's also keep in mind that, this 3 strike right here was achieved back in May. So it's been a couple, a month and a half, 2 months since this level was reached. So between Friday and August 20th, which is the next leg, it would take a pretty big drop just to get down here. But we know that 3 is going to be our break-even price. And Trader Cliffo in the Twitch chat asking if I don't have a position, is August 20th 3.5 strike for 70 cents a good play? And to that, I would say absolutely, because that is a huge amount of premium for a stock, at $3.50, right? What you would get if you set this up, your max profit is $6.50 and your max loss is $28.50. You've almost set up a play that has like the risk profile of a credit spread, but you've done it in a safe way via cash secured put. I love the value on the 3.5 strike for August if you're not already in one of those. So yeah, so as far as using puts to leg into a covered strangle, that's not something I'm a huge fan of for what we're doing until it gets a little bit lower. And what we know about puts, right, is if it gets lower to 3, these premiums will also increase. So we'll be able to get even more premium on those when we leg into the strangle. But if you're not in a play right now, these 3.5 strike puts for 65 or 70, or even the 3 strike if you want to get a little bit safer, right? The break even on these is going to be 280. Break even on these is going to be about 260. Honestly, the difference is kind of, but as we know, the probability of profit might be a little bit higher on these because your max profit is anything above 3 and max profit is anything above 3.5 on those. And just to better visualize the returns you're getting on these, the RORs here are phenomenal on a monthly basis, right? Fully cash secured, the 3.5s offer 23.89%, the 3s offer 14.29%. Anything double digit in the 10 neighborhood is really solid. We've got Prinzmeister saying January 2022s, the 2 put and the 2.5 put. Yeah, those might be a little down the road. What I do like to say, sometimes it can be fun when you're playing around with the basis of a stock to say, oh, if I sold this, it'd be down here, and then, scroll to a further expiry and say something like, oh, well, now I can sell the 2023s and my break-even price will be 85 cents, which looks incredible. However, in general, for stocks like this, you are going to be so much better off selling the nearest expiry possible. So we're going to go month to month to month to month. By the time we get to the August expiry, September's should be added, so we will be able to sell those as well. And with the amount of premium we have here, right, we could take a look at IV as it's been charted. Definitely elevated, but it can also get a little bit higher. The fact that IV is right here kind of at the midpoint of where it's traded, between February and now tells you that option premium on this one, at least for the next month or so, is probably here to stay. So the fact that we can knock 50 cents off our break-even price per month while still going decently out the money is phenomenal, right? Because if we get it down to 3 and we can knock 50 cents off a month, it's only going to take us 6 months, aka the end of the year, to have a zero basis in BBIG, and that's assuming the shares don't get called away. But again, we're going to be setting these up to where if they get called away, it'd be at something like 5, and we would be sitting on a really nice gain. So that is the spiel on BBIG, right? While it does suck that the thing dropped 7% against us, the strategy that we've implemented and the amount of premium that the options are offering make it so that, everything's going to be okay. This is working. I mean, I guess exactly as planned would be if it finished at 4 on the dot and we were able to take max profit. But, our contingency strategy is working just as planned. The option premium hasn't evaporated. We're going to be able to drive our break-even price down to about the 3 level, which it hasn't hit since the beginning of June. And, looking even further past that, 250 might be support, and then 215, 220 at the lowest. But based on the premium that we could see right here, it might only take 2 or 3 months for us to get our basis down there anyways. So I love the way this sets up, despite the fact that it has dropped off significantly. And I mean, this thing, it dropped from 4 to 350 at the blink of an eye. So there's no reason over the next 2 days it could jump back up to 4 and we never talk about it again because they get called away. But yeah, I really like the way this sets up, and I feel like I've spent way too much time talking about it. So we are going to move on to something else. Let me go back to our weekly recap screen. And I guess we'll cover a couple things really quickly. I did want to keep this one a little bit shorter because it was middle of the week and we started a little bit later. So 2 things we're going to talk about are going to be, the first is going to be the 10-day play strategy for earnings. And the second is we're going to take a quick look at the scan to see if there are any decent scalp opportunities for the end of the week, since that was something that we were able to do at the beginning of the week, right? We had some of these plays we set up where we had a little bit more free time on Monday, so we were able to watch the market closely. We decided we want to scalp a little bit, and that's something you could absolutely do. I always say our strategy can be as active or as inactive as you like, right? We get super active with scalping these options, but conversely, we get super inactive with selling December 7.5 strike puts on something where we're just sitting back and watching. Okay, so let's get into the 10-day plan. We could talk quickly about that because while we did end up, I guess we could technically say that we scalped CLF, that one did start as a 10-day play for earnings. So what do we mean by that? And I guess we can go back over, because I posted on our website, if we go to the blog over here, earnings not just for this week, but for the following week. And this is going to be how we identify 10-day plays. So if we look at the tiny little calendar that pops up here, the way a 10-day play works is you don't pick a stock that has earnings for the current week, but you pick a stock that has earnings for the week after. With that in mind, there is some peer-reviewed research that I could find the link to and pass around. I know we've thrown it in our Discord server a few times, but some peer-reviewed research telling you that over 50% of the time, stocks are green before earnings week, meaning that if they have earnings this week, they're green this week. So what do we do with that information? Since over 50% of the time stocks in the week before earnings go up, we translate that into our strategy by selling cash secured puts either right on the money or just out of the money, because that means with this added force of pre-earnings week, we're able to use those probabilities to further increase the probability of profit. So what we did with CLF, if you take a look at the chart, they have earnings not this week but next. Let's get the 10-day going right here, right? So where is Monday? Monday is right here. They gapped down pretty quickly, and we were able to get in on the gap down right around here. And what we sold, if you take a look at our tracker, was the 21.5 strike put, because At the time, it wasn't at the money. 22 would have been at the money, but I wanted a little bit bigger of a cushion just because this stock has run up so much in the past 180 days. So that's what we did, right? We sold a 21.5 strike put, which for purposes of this example and the 10-day play for earnings that we ran, we'll call that at the money. So, 50% of the time we know that it would go, or excuse me, greater than 50% of the time we know that it would finish above this mark right here. But what happened, obviously, as you can see by the chart, is that we got in and then it ran all the way up to 23.45 just that day. And the options that we previously sold for 42 cents a piece were down to 17 cents a piece. I mean, that's basically 60% of our max gain was realized in less than a day on that. So when you see that kind of value, we figured, it was a good idea to take money off the table, lock those profits, and you're never going to go broke taking a profit. So we were perfectly happy to do that. I threw this in here. Yeah, it ended up being, because there was a really, really low collateral requirement from our broker on this one, which was super nice. But it resulted in a 5.56% return in a day, which is just like a hilarious number annualized, so we can just kind of ignore that. And I think this ORPH play for annualization is totally just thrown off all calculations because our average return doesn't even fit in the cell after we got 16% in a day on that one. That was a fun trade. I wish we could find some more of those. But back to the point talking about CLF. We took that money off the table, so I guess technically you could call it a scalp. But, had you seen that play through and kept holding, you still would have been okay, right? Because your max profit point is right here. We sold those for 42 cents a piece, meaning your break-even price is down here, and it still would have been looking good. So that's the idea. You sell at the money puts or slightly out of the money puts if you want to be a little safer the week before earnings. And, most of the time you're going to hit max profit, but now, that begs the question, what happens if you don't hit max profit? And then the answer is going to be that you take assignment of the shares and then you sell calls for earnings. So we know that if we took assignment of the shares, right, we sold 21.5 strike puts for 42 cents. We would take assignment with a basis of $21.08, so $21.08. And I think just an easier way to visualize this would be drawings. So 21.5 is our first max profit point. That is close enough. Our basis, our break-even price is 21.08. I think I hit that one on the number. So if it stayed at, if it dropped down below 21.5, we're taking assignment with that. We get the shares over the weekend and headed into Monday. It's earnings week. And what do we know about earnings week? Call premium is inflated, right? If we look at call premium for this week, it's in the double-digit cent amount. Nothing out of the money above 35 cents. Half of that is a plus being over halfway through the week, but also another product of that, or another factor behind that, is the fact that it is not earnings week, right? So you'll see that IV is shown right here, 78% IV for these, and we could see 89% IV for July 23rd, and that is because they have earnings on 7/22 before market time, and that's perfect for us. We like it when they report earnings a little bit later in the week, right? So we sold cash secured puts this week. They have earnings this week, so on Monday, hypothetically, again, if this dropped, we would take assignment of the shares at 21.08, and on Monday we would sell covered calls. So the question now is, where would we sell covered calls? So if we zoom out a little bit on this, we could probably say, it looks like there's some support right at 20. So we would sell something to get our break-even price at 20. And to do that, we would sell 22 calls, which would get our break-even price down to 20. So this is our new break-even price as of Monday, right? So this week, this was our max profit point. By Friday, when we were assigned, this was our break-even point. Hypothetically, next Monday, when we sell the first set of covered calls, this is our new break-even price, right? So we already have a pretty significant reduction in break-even price. So what happens, right? We sell those on Monday. Let me pull the calendar back up. And then we wait until Thursday morning for earnings. And then, earnings are this big binary event. One of two things are going to happen. One, it's going to shoot up and it's going to get called away at 22 a share. So the stock that you have a basis of 20 in gets called away for 20, meaning you have a $2 gain per share, which, you have those shares at a basis of 20, meaning you get a 10% return in, a week and a half, 2 weeks, which you are going to do very, very well in the long run if you're pulling 10% every 2 weeks. So that's a win, right? And the way to think about this is there's 3 different ways to win during the 10-day play. The first is that, the first week, this week, it could finish above 21.5. You take max profit, you move along to the next one, that's a win. The second is, it goes against you off the bat. You take assignment, you sell covered calls, earnings go well, it shoots up, you get that 10% gain. That's the second way to win. Now, here's the third way to win. Thursday morning when they present earnings, like we mentioned, there's going to be one of 2 things that happen. The first is that it goes up, we win the trade. The second is that it goes down. But what happens when it goes down, right, is after the earnings, these are going to be basically worthless. So what you do is you close them out for, pennies. Let's say the stock dropped to like 19. You could close these out for pennies, and then due to the volatility of the downward drop, you could probably sell 19 calls, right? What we do is we close out the higher calls, and we'll have an individual gain on those, but those took our basis down to 20, and then we'll sell 19 calls. We might be able to get a buck on that, and then we could drop our basis down another $1 to 19. And again, this is all hypothetical. It's tough to say without numbers in front of it. I almost wish one of these went against us so we could, show you step by step what it looks like when you get to step 3 here. But the fact of the matter is, step 1 is successful over 50% of the time. So most of the time, you're not even gonna have to worry about steps 2 or 3. But then when you get to step 2 or 3, or when you get to step 2, which happens less than 50% of the time, you basically have a 50% chance from there of winning. So that's, a 75, 80% chance that you don't even get to step 3. But in the off chance that you do get to step 3, you could further reduce the basis and give yourself another chance to win. And if it still keeps going down past that, you just start wheeling the thing and keep selling calls week after week after week and reducing that cost basis. But that is how the 10-day play works. That is what we were doing with CLF off the bat there before the premium dried up and we took our gains. But that's also what we were getting at when we posted not just this week's earnings, but next week's earnings that we have on here. And if this loads when I click it, that would be awesome. Come on. Here we go. Perfect. So like we mentioned right here, we've got earnings for the following week, and these are useful in identifying a candidate for a 10-day play strategy for earnings. And for whatever reason, I have to embed this as an HTML item, so there's some weird scroll bars on it so you can't see the whole thing at once. But if you go all the way to the right, you'll be able to see ticker and market cap. We've got it sorted by market cap, so you know that what you're looking at are, actual decent tradable companies. The only caveat I have to that, which I kind of realized after the fact, is you're going to get some weird, OTC stocks, right? OTCM. These, I don't really know exactly what these are. They don't trade on U.S. markets. I mean, I know what Volvo, the company, is, right? But as far as trading them and the feasibility of that, I'm not too sure about. So if it says OTCM, you could ignore those. But the idea is if you wanted to do a 10-day play for earnings, you would pick out one of these, right? You see Microsoft has them 7:21 after hours. That's next Wednesday. What we would do to play that is we hop on over, we type in Microsoft. Nope, we try to type in Microsoft. 282.51. We take a look at the weekly puts. We go, 282.50 right on the number. It's already Wednesday night. There's only 2 trading days left in the week. These normally would have been a little bit more expensive than a 0.51 ROR. And in fact, I can tell you what if my internet cooperates with me here. At the beginning of the week, 12th. Okay, yeah. So it opened at 279.33. So what we would have done was sell 277.5 puts at the beginning of the week. And if we take a look at the chart on those at the beginning of the week, and again, this is the option right here that we're looking at, the 277.5 put that we were going to sell. They're now worth 33. Internet is really working overtime here. Come on. At the very least, I think we haven't had any technical streaming issues tonight, so I can consider that a small win for us. The chart is not cooperating, but at the very least, from what you could see up here, it kind of drives home the point a little bit that, this thing, the value on it has dropped like a rock. It was worth a lot more than 33 cents back at the beginning of the week. And let me go back to Microsoft. But yeah, and this also further drives home the point, right? Because at the beginning of the week, they were trading at 279, if the chart will ever come back up or if my internet is totally given out. But, they started the week at 279. If we sold these, they look like they would have finished at max profit, because we know that more than half the time in the week before earnings, the stock's going to go up. So these are things that you would have done, and I'll do a better job. I'll try to get this list out Sunday, so we could actually have a plan headed into the week here, instead of looking at these Wednesday night and saying, oh, this would have worked, this would have worked, this would have worked. But I'll try to have this, I'll have this list up this weekend, so that when we talk next Sunday night, we'll be able to actually pick one, and hopefully I'll get in on a 10-day play together so we could see how it progresses on a day-to-day basis. But this is what you would pick from. These are all companies with earnings next week, and that is how that would work. So hopefully that was a decent enough explanation of what a 10-day play is and how that strategy works in the context of what we're trying to do here with option selling. We are a little bit over the 30-minute mark. Quickly, we could take a look at our scan for high premium puts that are expiring in the next couple days, so we can identify some scalp opportunities. This is probably one of the best ways to do that is with this high premium scan. I don't know why I expected anything different from the internet here. I guess while I'm waiting on that, one thing you could do, Market Watch, if you go to quotes, they have some on Thinkorswim. They've got some pretty helpful lists that you could choose from. What I had in there was gap up, right? Because this specifically for our IV reversion strategy, a lot of the charts that we were looking at were these big gaps upward. And that's where we identified the increased implied volatility, and we're subsequently able to sell those deep out of the books for some decent amount of looking at this gap up list. There you go. If you go to the public percent through G, gap up is on there. You would hit gap up. I think my internet has just, or Thinkorswim has just had enough of me tonight, but this is where they would come up. That's a good thing to be looking at right at market open if you're looking for an interesting place to start selling some of those deep out of the money puts and scalp the, here we go. If you're looking for some of those deep out of the money puts and you're looking to scalp some option premium as implied volatility burns off, we've got implied volatility sitting here as one of the measures. For whatever reason, when I go top to bottom, it brings up the NAs first, but as you can see, some decently high IVs across the board. A lot of these are going to be companies who had earnings, and that is why they had gaps up or down. So it's one of those things where you just got to you have to be mindful and take a look at the chart, take a look at the events surrounding the company to make sure that you're not missing anything when you get in on something like this. But this is a great place to start for that IV reversion strategy and looking for things to scalp. And there we go. The scan's coming together. And what's also great about the scan is if you look at these lists again, you could do our high option premium scan just from that gap up list. And I'm terrified to hit scan again because I feel like it's going to take everything off the screen and take forever to load again. But instead of going to this Market Watch tab, looking at the gap up list and then typing every single one in individually to say, okay, this might work, this might not work, because some of these don't even have options and it's a waste of your time to even check. But you could literally scan from this list in our scanner with our parameters by setting scan in to that gap up list. And that's a very, very helpful way to get what we're looking for with that IV reversion strategy. So looking at what we have for the remainder of the week, these are all, a couple days until expiry. CYTK, that is some hilariously big premium. ATOS, we know, has some really, really solid premium. We were talking a little bit about those in the chat today with those 5 strike puts. I think 15 to 20 cents was a good expiry. If you could still get 15 cents, I really like that. It was getting a little bit dicey today when it dropped down to 6, but it bounced off that pretty nicely. 5 should be more than enough of a support level for the next 2 trading days. So I like what we're looking at right there with the 2.56% return on risk if fully cash secured, and a little bit better if you use a little bit of leverage. Back over to that scan, we see FGEN, CYTK. I think we talked about, excuse me, we talked about CYTK a little bit in the Discord server. And that was one I think was a little bit on the risky side due to the nature of the industry that it was in. MMAT is going through a weird half split, and I think that's what's inflating these numbers right here. So that may not be entirely accurate. We could take a look at it really quickly. MMAT, yeah, came off the highs. I seriously doubt that that's a legitimate amount of premium. What were we looking at right here? MMAT, it had, oh, there it is, 2.5 strike put. But that's going to be off the split options. And when you see these numbers on the option, right after the option expiry date, this indicates how, yeah, it tells you right there, how many shares per contract and dollar value. So what you see right here is 50 divided by 100. That's directly related to the fact that they had a 1-for-2 split back on June 25th. So in plain English, my advice for you surrounding these is do not mess with any of the yellow numbers here. Just strictly stick with options that have 100, because those are the ones that are going to be settled in the most simple manner. Sometimes there's some weird intricacies with split option settlement, and there's just no need to put yourself in that kind of a headache. So stick with the ones that say 100. Looking at that, I mean, the 4 strike offers 4.58% over the next 2 days, which is, you know, in a vacuum pretty good. But if we look at the odds that it goes back below 4, that's not a max profit point I'm terribly happy with, especially on a chart that looks like this. So it had a big run up. This thing was trading at, you know, 40, 50 cents back in November, December of last year. That's that kind of downside that I really look to avoid with stuff like this. So I would stay away from that one. And that's, you know, kind of inherently the nature of these scans when you're looking for a return on risk and have it sorted like that. A lot of it, that return is there for a reason, because there's a very tangible downside. However, when we find setups like BBIG, which was identified via the scanner, that is the situation we're in, where we're able to take a look at the stock, take a look at, you know, not just how our trade today would look with our break-even price, where we think we would be a month, 2 months, 3 months from now, and how that lines up with different levels of support or resistance on the graph. And that was one with BBIG. We were able to get comfortable with that. AMC, obviously, everyone knows what's going on with that. Absolutely tanking off the highs. I think it stalled out around $60 a share and is now on its way back down. I still would not want to get anywhere near this price point. I think it's only a matter of time before not just AMC, but GameStop. Newegg was one that we talked about. NEGG, that one's tumbling back down. Wish. It's just not a good day to be playing meme stocks, because I think the reality of what's been going on with the valuations on this is finally starting to set in. And a lot of the retail traders who had previously held those and had at least a little bit of a gain, for those that were able to get it on the earlier side, are starting to cut ties with those, lock in the gain, and play it safe from here on out. So that is not an area I would want to be. But looking down the scan, APRE, I mean, we could take a look at that one. I don't really know what APRE is. Therapeutics, yeah, biotech down. I don't know what happened here. I guess it started trading back in 2019. Huge gap down back in December of last year. There's some serious premium on those. Let's zoom it into the 10-day chart. Oh yeah, this thing was back at 472 on June 30th, which, you know, isn't terrible. I think, what was the strike that was offering all that premium? Yeah, the 5 strike would give you a 5% return. And the crazy thing about some of these healthcare and therapeutic stocks is that, you know, you would need $500, which if we're doing 10 of these, it would take $5,000 to fully cash secure them, but they only require half that. There's some very lenient buying power margin requirements on biotech stocks, which is, you know, at your own risk, take advantage of those. But it is something useful to keep in the back of your mind. Like with ORPH, CERE, those were a couple of those IV reversion biotech stocks that we played, but they weren't taking up too much buying power thanks to the generous buying power privileges that TD Ameritrade gave us. So that's kind of what the scan looks like. I mean, there's undoubtedly some really big numbers here with 2 days left in the week. Anything above, 1.5 for a 2-day period is really, really, really good. Just be mindful of what you're actually putting your money into. Rule number one, above everything else, right? Only put your money into plays that you would be comfortable buying the stock at the price that it's at today. And if you follow that rule, you'll never be too upset with what we're doing with our strategy. We could look at PLBY. That's interesting. That one used to be up at like 60. That one is tumbled back down to earth. And if we zoom out, this kind of further drives home the point about a lot of these overvalued stocks. So many stocks make the news when their charts look like this. And you're looking at this saying, oh my gosh, it's been going up and up and up and up. Should I get in on a stock like this? Because not only is it tempting to get into a stock like this because obviously the upward potential is there, it's also tough to avoid because stocks that look like this, where they've gone from 10 to 60 in a matter of 2 months, those are going to be the ones that people on social media are talking about. So you're going to be drawn into those. But it is almost inevitable that the back end of it kind of looks like this, like our close personal friend Hyliion back over the last year. Really similar setup. I got to go further than a year back, huh? Super big run up. Everyone's getting in. I got suckered into it before I really knew what was going on with stuff like this, and I paid the price for it. So hopefully I lost all that money on a setup like this, so I can impart the lesson upon you guys that you should not pursue similar setups and lose similar amounts of money to what I did. But yeah, I mean, we're 45 minutes into the stream, so probably looking to wrap it up soon. One quick thing that I'll add on here is the watch list. This is a watch list I put together. I think it'd be cool to quickly go over this because this is one of the things I talk so much about, rolling out an HT premium thing. And for those of you who are watching along tonight, I'll say this is a sneak peek at it. But, I mentioned when I roll out HT premium to try to put some more content instead of putting things that I currently have behind paywalls. This is one of those things that is in line with that idea, right? Something that I would be adding to bring more value as opposed to just calling everything in our Discord server premium and pulling the rug on everyone. So what we have here are a lot of the tickers that we talk about in the Discord server, right? We've got the price that gets pulled in live. We've got the profit and loss. And we talk so often on here, and when we come to conclusions on stocks that we analyze, we say, okay, this is a price I would be happy to get in on. And when I do that, I take notes down and I put them in here. So we have all these stocks with corresponding prices that I think would be a good idea to get in on them at. And one example from Sunday night was STEM, which was trading at about $30. We took a look at the chart. We said, hey, let's hold off on this thing till 20. And as you can see, a big red day to take it back down to 26.85. And it's on its way tumbling back down to 20 to give us a little bit of a better entry point. And one of these things where it's not definitive that the second one of these things lights up green saying, yes, our entry point has been reached. It's a good idea to get in on the play. Things could change, obviously, on a day-to-day, week-to-week, month-to-month basis. So it's important that when you see a yes here, that you still do that further last step of a little bit of due diligence, making sure that, this stock didn't just completely drop off the face of the earth because they had horrible earnings or they reported fraud or something like that. But in general, I'm going to keep building out this list. I've only done this based off the last few streams and some things from my personal watch list. But the idea is to get, a ton of different stocks on here that we talk about with a lot of different price targets. Because if you've got a watch list with, 5 to 10 different stocks, don't get me wrong, that's an awesome start. And it's great to have an eye on a few different stocks so you're familiar with the way that they behave and you understand good entry and exit points. However, it can get really impatient if you're watching 5 stocks and all these stocks that you want to get in on, you're waiting on 5 to 10, 15, 20% drops. That is a good way to get very impatient and jump the gun on a trade when the entry point isn't as good as, you would need it to be to have some sort of decently profitable setup. So the more we get on here, the more price targets we're going to have, the more likely it is that, every week we get 1, 2, 3 new opportunities for entry. So I think that's the value there. It helps a lot when we have the stocks that we talk about every single week on the streams, and then aggregating all these and I do my own research through the scans. I take a look at the charts during the day and add some other names onto here for decent entry points. But that's the idea behind this, and I think this could end up being a super, super valuable schedule for you guys. So if you're looking at a stock and saying, hey, I don't know if this is a good place to get in, hopefully this gives a little bit more definitive of an answer. And I'll try to add some notes too, because some of these numbers without context might not mean a lot, right? I've got a 120 price target on Apple that's trading at 149. Does that mean that you shouldn't get into Apple? No. It just means for the purpose of what we're doing in our option selling strategy, 120 is kind of the level where I think the trade-off between the amount of leverage I would need to take on to get into that position and the amount of return we would get combined with our basis and support on the stock is something I'd be comfortable with. So I'll try to add some more to these notes to give a little bit more color to what a lot of these price targets are based off of, so that you're just not looking blindly at a number on a screen. And hopefully with that all included in there, that'll provide some decent value. But, this is the sneak peek at it. It'll get bigger as time passes, as we make money. But this is one of those things I was planning on including in the HD Premium package, which I feel like I allude to all the time, but never actually roll out. It'll be coming. So keep an eye out for that. And that is pretty much everything I wanted to run through tonight. So thank you guys for joining us on the impromptu midweek stream. We got a good 45-50 minutes out of it. Not too bad. Hopefully we were able to add a little bit more value to your trading week, talking through some of our positions, taking a look at that scan, and then talking through some general strategies like the 10-day strategy that we've been using. So with that, I'm going to cut it off so I get in before the bell at 11 p.m. Eastern time tonight. But again, thank you guys who have been tuning in Sundays and even tonight on the last second streams that we've been running. I really, really appreciate it and enjoy, setting these up and talking with you guys and running through these. Because like I mentioned, hopefully it helps you, but it also helps me equally to talk through some of my ideas. And then as I'm saying them out loud, realize if I sound like a total idiot or if we're kind of onto something. So once again, we'll in a very corny manner, we will sign off the way we always do, saying, thanks for watching. This has been the Hourglass Trader, where as time passes, we make money, and we will see you, hopefully all of you, next Sunday night as we get ready for another week of trading. Hopefully this number turns green by the end of the week. I'm not counting on it, but hey, small losses, those are decent weeks as well when the market takes a little bit of a downturn. So hopefully we'll see you guys next week. Thank you so much for watching, and I hope you guys have a good rest of the week, both personally